Hi, it's me, Dominique Molina, and I am very excited. It's a great day over here. Now that we have the news on the tax extenders update, I wanted to get this information out to you exclusively and quickly so that you can get out there, incorporate this stuff into your year-end tax plans. We have 10 days to go, so I'll give you some recommendations at the end of this short video. Let's jump in and get started. So first thing I want to share with you, and I've been talking about this for some time, but this is great news because it was actually made permanent, is the small business stock exclusion. This can be a wonderful future planning technique that you can use either with startups or even existing businesses as you're guiding them through their exit strategy process and planning for long-term capital gains. Savings by purchasing stock in small businesses, in qualifying small businesses, that is. They're not only diversifying their portfolio, but finding preferential tax treatment. So it converts capital losses to ordinary losses, allows you to defer tax on the gain and exclude up to 100% of the gain. It's got to be held for 5 years. And it depends on the acquisition date, but if it was acquired in the last handful of years, since 2009 to be exact, the qualifying stock sale can be 100% gain excluded. There are qualifying businesses, of course, and we've got more resources available to you in the CTC toolbox as long as you're a CTC member. But gosh, can you imagine explaining to your client that when they sell their business, whether it's for $10 million or $200,000 or even $20,000, that gain could be excluded from tax altogether? Pretty powerful technique, and now we have the enjoyment of that being permanent. So excited about that. The assets, of course, cannot exceed $50 million, and there's certain businesses that don't qualify, but assuming that you meet all of the qualifications, it can be a wonderful loophole to use with clients. We also now have the answer on our depreciation problems. Cost of business assets generally has to be depreciated over a period of years. So generally we look to use makers. However, we have enjoyed this bonus depreciation for quite some time, and this was also extended with our extenders package. However, it was not made permanent, but we do have a long-term extension here. In fact, it's been extended through December 31st of 2019. This applies to 50% of bonus depreciation on brand new assets, new tangible property with recovery periods of 20 years or less. So can be a great way to bonus some of that expense if it makes sense. So remember, $1 of this bonus depreciation expense can be worth 10%, or it could be worth 40%, depending on what your client's tax bracket is at the time that the depreciation is used. So do your long-term strategy planning, just like we teach in this program, because you may want to opt out of the bonus depreciation if it makes sense. Now, in addition, let's say that you want to be able to create a net operating loss. The 50% bonus depreciation can be the way to go, because it can be used to create an NOL, and you can carry that NOL backwards and actually get refunds for your clients. We offer a plethora of training on NOLs and how to plan with them to get cash in your client's pocket, so make sure you put that training to good use. I mentioned some phase outs of this starting in 2018. It will be 40% bonus depreciation, and then moving into 2019 before it's phased out completely, we'll see that bonus amount of depreciation reduced to 30%. Now, Section 179 was also permanently extended. It applies on up to $500,000 worth of qualifying purchases, and we'll see that phase out when the purchase of assets gets to $2 million. So we'll see a dollar for dollar phase out there, and it's completely phased out once the purchases exceed $2.5 million. Only Section 179 expense can be applied toward used assets, so you want to keep that in mind. And if your asset purchases exceed the phase out threshold, or go beyond zero, including as far as your taxable income goes, then you might want to consider the 50% bonus depreciation, which can be used in either case. Keep in mind, assets have to be placed in service before year end, so you want to pick up the phone and start dialing now to get your clients access to this information so that they can make use of it now, and you can incorporate it in your tax plans. Now, when we talk about vehicle-related tax breaks, we do have the upcoming year's standard mileage deduction that was dropped to just 54 cents per mile, so we're seeing a corresponding reduction that matches our change in fuel prices that we've seen recently. Purchases of new or used vehicles may be eligible for Section 179 expensing, and new vehicles could be eligible for bonus depreciation, but keep in mind that the limitation is $11,060 for autos that are placed in service in 2015 or 16. It can be increased to $25,000 for autos that are eligible for the bonus depreciation. Those are vehicle capacity weights of $6,000 or more. And then keep in mind of your specialty vehicles that can go way beyond that should they be commercial vehicles. And there's a lot of requirements for that, but certainly not impossible. And there's additional rules and limits that apply, so be sure to check those rules. Finally, along with protecting and long-term appreciated assets within a C corporation, we now have a vehicle or a mechanism for getting those assets out of C corporations without the dreaded double tax on the gains that may be included there. And that is a nice permanent extension of the reduced built-in gain period for C corporations converting to S status, and that has now permanently been reduced to just 5 years. So again, when you're looking to do long-term planning, you now have a tool so that you can help your clients avoid millions of dollars in built-in gains tax, and that's by quickly making this S election, knowing when to do it in a late S election status or approval, so that you can start the clock ticking toward that built-in gains holding period, and can be a really effective tool to save lots. Again, that has been made permanent, and it's an excellent tax planning strategy for C Corps who already have appreciated assets, so that you can avoid that dreaded double tax. Another exciting news with our extenders bill is that the R&D tax credit has been made permanent. I think this thing has been extended like 16 different times. It saves more than $12 billion in tax annually. To use it, what you're going to do is calculate how much you spent on qualified research expenses in the 3 preceding tax years. You're going to average those amounts, then multiply by 50%. That becomes your credit base, and then your actual credit equals 14% of any of your qualifying R&D expenditures that exceed that base. But keep in mind, you don't have to have white lab coats and beakers just to qualify for this type of credit. It can be any type of research that leads to improvement in performance, functionality, reliability, quality. It can apply to a product or a process or software. It can apply to a technique, a formula, or an invention. And so this can apply to lots and lots of different types of business industries. So you want to make sure that you're not missing out on this, because this tax credit is a dollar for dollar reduction off of the tax bill. There are some new features to this benefit that were made permanent. Now it can be used to offset alternative minimum tax, and it can also be used in certain situations to offset payroll tax for small businesses. So it's an extremely wonderful opportunity. You want to make sure that you are recommending all of these strategies where it makes sense to your clients. Now, there were an awful lot of other things extended, and a lot of things that were made permanent, some that were just extended long-term, and some that were extended for the near future. You want to make sure you're following a good resource for that, and you want to be in communication with your clients about this. So for those CTC members that are out there watching this, we've got a client alert that's been prepared for you today. It's hot off the presses. You can find it in the CTSU toolbox. Just look in the forums under this post where you see this video posted, and you'll be able to get that out. I highly encourage you to do it by mail, but if you just don't have the time available, email will do, but I certainly love an opportunity to touch my clients through physical forums as well where it makes sense, and the U.S. Postal Service is still a very affordable way to do that. Thank you for watching, and I hope you found tremendous value. You've got 10 days left. Make sure you're charging for the value that you provide with these strategies and more. And if you're interested in learning more how to apply this value pricing to your practice, there's 3 elements that really come with this. Number 1, you want to make sure that you're constantly learning new advanced tax reduction strategies, because your clients deserve to keep more of these dollars in their pocket. It belongs there. Second, you want to make sure that you're using an efficient strategy to implement value pricing in your business. It's a leverageable model that allows you to change the way that you're doing business, earn a lot more per client so that you can afford to reduce the volume of tax clients that you're working with and offer greater levels of service to those clients. Your staff can do much better with less. And then 3, you want to make that sustainable by making sure that you have connections and support tools, software that can help you in your mission to do that, so that you can completely do this year after year, that it's not just a one-hit wonder. If you're looking for more information on how to do this, please stay connected to us here at CertifiedTaxCoach.org. Happy holidays.